Thank you, Keith. We appreciate the invitation to speak at your conference this week. So I'll give you a quick summary of Chinook Energy. There's a more fulsome report on my table out in the lobby there, and if you want to ask any questions, feel free to come by later. So what is Chinook? Well, as of yesterday at market close, I think we're a $285 million market cap TSX listed company. I guess what we're stressing these days is the fact, as Keith mentioned, we're currently carrying zero debt, and in fact have $70 million in the bank account as of the start of this year. And on top of that, we have a $125 million credit facility that's completely undrawn today. So we're sitting in a position where we think we can certainly take advantage of our own opportunities that we've got internally for growth and any M&A side activity that could come up in this soft commodity cycle. We're currently about a 7,000 BOE a day company for 2015, obviously pretty gas weighted, and we've become a very Montney-focused company in the last year and a half. We have a liquids-rich gas prospect in the Montney as well as an oil and gas prospect in the Montney. I'll get into some detail on those shortly. And I think we're an experienced team with a track record of not only growing junior and intermediate companies, but responsibly managing them through some tough times that we've had in the last 5 years or so. So why would we recommend you should invest in Chinook? Well, as Keith mentioned, since we went public in 2010, we haven't issued another share since that day. We've strengthened the balance sheet over that time from almost 4 times debt to cash flow to our current positive net cash position. And we've transitioned the company over the last year from what was a very confusing hybrid international producer with a Canadian production base and very diversified even across Canada to what's now a Peace River Arch Montney-focused company. Peace River Arch area straddling the BC and Alberta borders up in the northwest part of Alberta. And how have we done this transition? Well, by selling a lot of assets. We've shrunk our company since 2010 by half in terms of production. But for the first 4 years of that, we actually increased cash flow per share as we were shrinking the production. So we were selling assets that we deemed non-core, and we were getting good prices for them. And most recently, I guess the notable sale was our sale of our African assets in Tunisia, which we just closed this last August. And we got, I think, $125 million US for that deal back when Brent was still trading above $100, and God forbid we still owned that property today. We wouldn't be sitting here bragging about our strong balance sheet. Within Alberta, or within Canada, sorry, we've also spent the last few years repositioning ourselves as a Peace River Arch player. We've developed our own lands, we've got prospects we've drilled, we've bought crown land and drilled wells, successful wells on them, and we've bought select assets that we thought were the right piece of property for us to own and exploited them and grown them very dramatically over the last 2 years. Most recently, we've got 2 material Montney discoveries we drilled in 2014. One area in Birley, northeast BC, is a liquids-rich gas part of the Montney, and at Gold Creek in Alberta, we're actually into an oil and gas part of the Montney fairway there. We've got 2 wells drilled into each of those plays, and both of those are set up for significant internally generated growth if and when commodity prices warrant that kind of investment. And again, what I'll stress is our financial strength today provides us this flexibility and optionality to either choose to accelerate our own capital program or hopefully take advantage of what looks like a pretty attractive M&A part of the cycle coming in the next quarters. So just go through a bit about what's changed at Chinook over the last couple years, even over the last couple months. We went into 2015, we set our budget at $135 million at the end of last October, which was going to be a huge growth story. We were going to add 50% volumes year over year, drill 20 horizontal wells, build a big facility at our Birley property, and really start growing that liquids-rich gas play. And of course, as the commodity prices deteriorated through the last quarter there, we came back to work after Christmas and said, you know what, we have a great balance sheet right now, let's not jeopardize it. We chopped our capital program down to $45 million, which is essentially down to 5 horizontal wells, 4 of which are already drilled. On the facility side, we cut the building of a facility to expand, but we did pay for a bunch of the hardware that would go into building it. So I'll get into a bit of detail on the next couple slides, but when we decide to hit the go button on that, the market will really see that we can add significant growth volumes for what is going to look like very low dollars at that time, which is right now we're guessing 2016 gas prices come back to a point where we want to hit the go button on one of those projects. And just highlighting on the bottom there, our Montney drilling program in 2014, we didn't cut our capital budget because we had a tough year. Everything we did worked, met or exceeded our pre-drilling forecasts, and you can see some of the test rates we got on our wells. Of the 4 horizontal Montney wells we drilled, we got 3 of them on production last year, and the 4th one is just awaiting tie-in currently. Talk a bit about our Birley property in BC. The red lands on the map on the left is our Montney position. It's about 65 gross sections of land. We have about 85% net working interest over the balance of it. Hard to see at this scale, but the green and yellow lines are the wells we've drilled to date. We drilled 2 wells last year and got them both on production. Those are the yellow lines. So not only did we drill our first well about 13 kilometers away from the nearest operated Montney activity, which happens to be Storm directly to the south of us, and Progress to the west. We drilled in that location not because we thought we were so smart. We drilled as far away as we could, but Chinook owned some legacy infrastructure, being pipelines and gas compressors, that we were able to drill right beside and not only test our concept for this play and see if it produced economic volumes of gas, but get it on stream literally within weeks of rig releasing the well. The 2 yellow lines on the map there relate to the graph on the top right, the production curves. We've got an idealized type curve we've been using, basically a 4.5 million a day gas well with some liquids is the black dashed line, and the purple and red lines are the actual 3 and 6 months of production history we have on those 2 wells. So we haven't adjusted our own economics, even though this still makes an economic return today. It just doesn't seem to justify the kind of expense we would be looking at to go in here and drill a dozen wells and build a big facility expansion. But the wells are exceeding our type curves by 30% and not showing any signs of stopping anytime soon. The graph on the bottom of the right side there is just illustrating the growth plan we did put in place for this area back in October. And we had several phases of expansion, taking this property up to 60 million cubic feet a day by 2016. We've stopped right now at basically the second leg up on that curve. We've got 9 million a day of gas takeaway capacity in here. We're at that with our 2 wells. We'll bring 1 more of our 6 wells on stream here in the first quarter, and the other wells will sit there until we decide to hit the go button on this expansion and add a 25 million a day expansion for that facility, which we're guessing is going to be Q1 2016, but still totally dependent on natural gas pricing. Now that 25 million a day doesn't maybe sound like a big deal to everybody, but for Chinook, we're a 7,000 barrel a day company in 2015. Each 25 million a day bump in gas production grows your company by 50%. So we can look at doubling our corporate production over the course of 12 months if and when we hit the go button on this project. And with our delineation and the success of our first few wells, we feel pretty comfortable that it's been de-risked, and it's just a matter of timing the market. The other area we were active in last year is the Gold Creek area of Alberta, and this is in the oily or very high liquids content part of the Montney. There's been a number of recent wells drilled offsetting and immediately adjacent to our about 50 section land base that we own in here. There's been oil rates up to 1,500 barrels a day. Companies like CIOC, CNRL, Shell, Inception, Blackbird are all active immediately around us, and we've been watching and monitoring their well results. And then in 2014, we decided to go in and drill a couple wells on our own, partly to validate some of our lands, which we've taken care of any expiry issues at this point. And we tested both wells. You can see the rates there. They were, again, meeting or exceeding our type curves. And the well down in the right-hand corner of the map sheet there, we did bring on production in November. Came on at almost 1,100 BOEs a day, and the IP90, I think, through February was 950 BOEs a day. So really strong wells, and we can accelerate this program again at any time. We've got over half a dozen locations surveyed, ready to go. We've just said for this year, let's restrict the capital spend and keep our options available for other opportunities. So in summary, I'm down to 8 seconds, so it's perfect. You can read those points for yourself. I'll just stress the last point there, that our strong financial position hopefully gives us an advantage in this softer commodity cycle, and we can choose to either take advantage of M&A opportunities to grow our company, or if prices allow, we have lots of opportunities internally to grow the company through the drill bit. Thank you.